As the year comes to a close, many of you are probably looking at your tax situation and wondering how you can lower that looming tax bill. Depreciation is one of the most powerful tools investors have to reduce taxable income. But the real question is, what asset classes should you choose to help you do that? Different asset classes offer different levels of depreciation, and today we're going to compare some of the best options to help you decide which is right for your tax strategy, with the caveat of not letting the tax tail wag the dog. Welcome to the Best Ever Real Estate Podcast, the show for the Best Ever Commercial Real Estate Conference for passive and active investors. If you're interested in attending the next Best Ever Conference in Salt Lake City, happening from March 3rd to the 5th, 2025, make sure to grab your early bird tickets before the price goes up. For those of you who don't know me, I'm Pascal Wagner. I've spent years working in venture capital at Techstars, where we deployed over $150 million in different early stage companies. And I'm also a limited partner in over 20 deals across different asset classes, generating more than $250,000 a year from a combination of active and passive income sources. My mission is to help you build a diversified cash flowing portfolio that supports your long-term financial goals. Now, before we dive into today's content, I want to clarify that we'll be discussing general tax concepts, and every investor's situation is different. And each deal can vary significantly in terms of how much depreciation or other tax benefits apply. And so it's essential to work closely with a qualified tax accountant or an advisor to review your specific circumstances before making any decisions. The strategies I'll be sharing here are just one part of the tax planning conversation. And with that, I'd love to dive into the concept of what is depreciation. So depreciation is an accounting method that allows investors to deduct the cost of a tangible asset over time, reflecting its gradual loss in value due to wear and tear and aging. For real estate investors, this means that instead of deducting the entire cost of a property in 1 year, they spread out the deduction over the asset's useful life, as determined by the IRS. This helps reduce taxable income each year, providing you a significant tax advantage. According to the IRS, residential properties can be depreciated over 27.5 years, and commercial properties can be depreciated over 39 years. In real estate, this means that every year you can take a portion of the property's value as a depreciation deduction, reducing your taxable income even if the property's actual market value is increasing. So that's depreciation. Now I want to talk about the impact of the Tax Cuts and Jobs Act of 2017, which introduced significant changes to how depreciation works. Most notably, what many of you might already know as 100% bonus depreciation. This allowed investors to immediately deduct 100% of the cost of qualifying property in the year it was placed into service, instead of spreading that deduction over the many years. 100% bonus depreciation under the Tax Cuts and Jobs Act investors could immediately write off the full cost of depreciation assets, such as building components or certain equipment, in the first year. And this accelerated depreciation was available through the end of 2022. However, the bonus depreciation percentage has started to phase out. In 2023, bonus depreciation dropped to 80%. This year, in 2024, it will decrease further to 60%, and it continues to phase out by 20% each year until it completely expires at the end of 2026. So why is depreciation so appealing? Well, for real estate investors, depreciation provides a powerful way to reduce your taxable income while owning an asset that might be appreciating in market value. So, for example, if you own a property generating rental income, you can deduct part of the building's cost every year, reducing your income taxes on that rental income, even if the property's market value is rising. And by combining these cost segregation studies, investors can accelerate the depreciation that they would normally take by breaking down parts of the property like appliances, flooring, lighting, HVAC into shorter depreciation periods. Some are 5 years, some are 7 years, some are 15 years, resulting in substantial deductions up front. Now, while these tax advantages can be substantial, it's important not to let the potential for depreciation benefits drive your investment decision. Tax benefits should enhance an already sound, great investment and not justify one that doesn't align with your long-term financial goals. Something I always ask myself is, would I still make this investment even if there were no tax advantages? So we'll dive more into that in a bit. But to start, I'd like to talk about 3 different asset classes and how they kind of all vary in depreciation. So maybe what you might want to look more towards based on what you need in your portfolio. So the first is multifamily real estate. So multifamily properties offer a reliable depreciation because they fall under the 27.5-year residential depreciation schedule, even though they're often seen as commercial investments due to their size and scale. That's something I kind of learned in that research process of going through this. Even though they're commercial properties, they fall under that residential timeline. So using cost segregation, investors can then reclassify the building components like the appliances, the HVAC systems, into those shorter periods, 5, 7, or 15 years, which helps boost the upfront deductions. So, for example, a $1 million multifamily property, cost segregation might allow you to deduct $142,000 in the first year compared to the $36,000 if you're using the standard 27.5-year schedule. This upfront benefit helps reduce the taxable income in the early years, providing you additional cash flow, or I guess like less tax on that income. So to put that in perspective, on average, for every $100K invested in a multifamily property with cost segregation, again, these are general numbers, an investor could see, maybe 30 to 50K in depreciation deductions for their first year alone, depending on, where bonus depreciation is and other metrics in the property, which I'll get to later. But for someone in the 37% tax bracket, this could result in $11,000 to $18,000 in tax savings. So why choose multifamily? Multifamily provides long-term stability, provides cash flow, and they provide tax benefits. And while the upfront depreciation might not be as high as some of the other asset classes we're going to talk about, the combination of the reliable cash flow and the tax advantages kind of make it a balanced choice for investors seeking lower risk compared to the more volatile options that we're going to talk about here in a minute. The second asset class that I'd like to go into is mobile home parks. So mobile home parks provide some of the highest upfront depreciation due to their reliance on infrastructure such as roads, utility hookups, and other improvements. These infrastructure components are depreciable over 15 years, and bonus depreciation allows for a larger portion of that investment to be deducted up front, especially for parks placed into service before 2023. So if you invest $1 million in a mobile home park, much of the investment is tied up into the rapidly depreciation in infrastructure. So we're talking you're able to deduct nearly most of that investment. So on a percentage basis, for a 100K investment in a mobile home park, depending on how much of the investment goes towards the depreciable infrastructure, you might be able to deduct 70 to 100% of your investment the first year. So for someone in the 37% tax bracket, that could result in $25,000 to $37,000 in tax savings alone. So investors, along with many of the benefits of just being in the mobile home park asset class, investors who choose this, they do so for greater upfront depreciation. They also tend to require more active management, but there are additional operational challenges that come with mobile home parks. But as a passive investor, not really something that you need to deal with. So uh, that's one of the many reasons why people choose mobile home parks. And the third asset class I'd like to get into is oil and gas. Oil and gas investments provide some of the most powerful tax benefits available due to what's called intangible drilling costs. These are the expenses related to the drilling operations, like labor, fuel, repairs, that don't really have a salvage value. And what makes these intangible drilling costs so attractive is that they typically represent 60 to 80% of the total investment, and they can be fully deducted the first year, which provides obviously significant tax relief for high income earners. What's unique about oil and gas is, unlike most real estate depreciation, which only offsets passive income, um, depending on how the investment is structured, oil and gas can also be applied, those deductions can also be applied towards active income, such as wages or business income, which makes oil and gas investments particularly valuable for investors looking to reduce their taxable income from salaries or other sources, not just your passive investment income or capital gains. So to put that in perspective, a $1 million investment in an oil and gas project, maybe up to 80% can be deducted the first year through these intangible drilling costs. So for someone in a 37% tax bracket, this could result in, over $296,000 in tax savings the first year. So these are huge, huge tax breaks for high income earners who can lower their taxable income substantially. So these are a great option. I've invested in one of these, and I'm currently receiving my distributions. And they're great for people who need to reduce, active and passive income. The deductions up front from these intangible drilling costs offer immediate tax savings. But I would also just remember here that oil and gas is an insanely volatile market, and these also carry significantly more risk. I've done a lot of research in this space and have found that oil and gas is one of the most riskier classes that I've invested in. Now that we've broken down the unique depreciation benefits of multifamily real estate, mobile home parks, and oil and gas investments, let's quickly recap the main points and the tax saving potential of each asset class. So the first, multifamily real estate typically offers, 30 to 50K in depreciation for every 100K investment. Mobile home parks, can allow, 70 to 100% for every 100K invested. And in oil and gas, 80, around 80% of everything invested. Now, everything is totally dependent on your operator, where bonus depreciation is, and there are a lot of factors that go into this, but I think as a general rule, you can kind of see how each of these asset classes compare to one another. And now I want to talk a little bit about a personal story of how I've learned about depreciation in one of my personal investments, which was back in 2022. I invested in a retail redevelopment opportunity in Denver, Colorado. And like many investors, I was excited about the potential tax benefits, especially since the depreciation I expected to take in that year. And what I find it with, as many operators do, the operator talked up about the depreciation benefits, and I was ready to use them to offset some gains that I had. But I didn't really understand how depreciation worked in this context, which is why, I tell you, you have to talk to multiple experts when it comes to this. I'm really just providing you a basis or a foundation that you can go and ask more people. But here's what happened. So when I made the investment, I assumed I'd be able to take that depreciation as soon as I invested. But what I didn't realize was that depreciation couldn't begin until the property received its certificate of occupancy, i.e., it was placed into service. So, the because construction was delayed, that building didn't receive that certificate of occupancy until the following year, and which ultimately made me miss out on the tax benefits that I was expecting to get in that first year I was making. And while I didn't need the depreciation in that tax year, it was definitely a bonus. It was definitely a frustrating lesson. And this experience taught me that operators often sell the depreciation dream, but you need to dig deeper to truly understand when you can take advantage of it. So for me, it was just a reminder that tax benefits should always be secondary to the fundamentals of the deal, and you need to know how they are in play. So now, while depreciation offers significant benefits, the amount you claim also varies on several factors, such as the age of the property, the operator's experience with cost segregation, how aggressively components are reclassified into shorter depreciation schedules, and I want to explore, how different operators and property types can influence those depreciation outcomes. For example, older properties. Older buildings may offer more upfront depreciation because many of the components are nearing the end of their useful life, allowing for more aggressive classification, which leads to faster write-offs in that cost segregation process. Newer properties might not offer as much upfront depreciation, and although they tend to have fewer maintenance issues, which could result in more consistent cash flow, the depreciation benefits are lower. And then I would also just comment here that operators with more experience in cost segregation, I think, can maximize depreciation more effectively. So they know how to break down all the eligible components, what makes sense, what doesn't, and reclassifying them into shorter depreciation schedules. So maybe a good question to ask your operator if you're focused on depreciation. Ultimately, understanding these factors will help you make more informed decisions about how much depreciation you can realistically expect from a particular investment. Now, if you're looking for opportunities that provide great depreciation benefits, but are maybe also solid long-term investments, I've got something for you that you'll want to check out. Every Friday, I send out Deal Flow Fridays, a weekly email where I curate investment opportunities from across the market. And these deals include multifamily, mobile home parks, and even these oil and gas investments we're talking about, which offer tax benefits like the depreciation, and more importantly, are just well-structured opportunities for building cash flow. If you're ready to reduce your tax burden while building your wealth, head over to the passiveinvestingstarterkit.com to sign up. You'll get my starter kit, which includes my daily newsletter and daily, Deal Flow Fridays, a curated database of investment opportunities. Now, to wrap this up, as the year ends, remember that depreciation is a great tool for tax savings, but it should not drive your investment decisions. Focus on strong assets with sound fundamentals and use depreciation as an added bonus to enhance your portfolio. If today's episode helped you rethink your year-end tax strategy, share it with a friend who's also looking for smart ways to reduce their taxes. They'll thank you. Thanks for joining me on the Best Ever Real Estate podcast. I'm Pascal Wagner, and see you next time.